Hello, and hi there. Welcome on screen again. Fella, it feels good to see you on screen, and especially at this time as we have just uploaded a new video in this channel. Thank you, fella, for being here, and thank you for being considerate to Rita Finance YouTube channel. And with that said, I'd like to take this opportunity to welcome you in Rita Finance YouTube channel. And if you're new to this channel, warmly welcome. Subscribe to it. And if you're a regular viewer and you are yet to be one of our subscribers, please feel free to do so. Consider to be one of our subscribers by subscribing in this channel. Share this video with our friends, loved ones, workmates, schoolmates, relatives, or with anyone who you think is going to benefit from the teachings that have been provided in this channel. And don't forget to like this video as well. And click the notification bell so that you can be notified once we upload a new video in this channel. My name is Rita JL. Warmly welcome in today's episode. So fella, in today's episode, it's all about finances, and still we're in the banking industry. And today we're going to learn about simple interest and compound interest. And without further ado, let us go to the details of the story. So fella, understanding interest-bearing saving account can help you know more about your finances, as banks provide different types of accounts that can have interest rate on its interest that is paid based on the principal amounts that you have deposited in your account. So by keeping money in an interest-bearing account, the bank will pay you money on that deposit. So you have to understand these interest-bearing accounts, that on how they work, and to understand them, you have to understand the two types of interest. First of all is the simple interest, and the second one is the compound interest. So with the simple interest, or earning simple interest, with the simple interest, you can earn interest based on the principal amounts that you have deposited. So this is calculated at a regular interval, and it will be usually paid out at the end of the investment period. Maybe it's for 1 year, 2 years. So that will be paid at that specific period that you have been set between you and the bank. So the percentage is always the same, and your money grows when you add more amounts to that deposit, because you'll be able to earn a percentage of interest at the larger amount. So that's if the principal is larger, then the interest amount will be larger. So this is the simple interest. It's usually paid on the principal amount that you have deposited. So coming to the compound interest, or the earning compound interest. So the compound interest pays more interest because it's based on the principal plus the interest that has already been paid. So in other words, you earn interest based on the amount you have deposited plus the interest rate that was previously earned. So with compound interest, you earn interest based on the amount that is in your account is paid back into your account, which will increase the total amount. Then after the second period now comes, the interest paid to your account, it will take into account that principal that you put and the previous interest which you earned while the tenure is ongoing. So put it simple, that compound interest is the interest that you earn on top of the interest, causing your money to grow exponentially without you adding into it. So it will multiply the interest rate of the interest amount that you have been paid in the previous tenure plus the principal. Then if you come to it to roll it over again for a certain period of time, the interest rate amount will be calculated based on the principal plus that interest that you earned previously. That's why the money which with compound interest formula, the money grows exponentially as you have added interest based on top of the previous interest that has been paid into your account. So it is important to note that this distinction does not change in the interest rate percentage itself, but only on the amounts that has been earned while you are earning interest. So the interest that you have been given will not change. Maybe it's 10% or 15%. That interest will not change. But what will change is the amount. If the amount increases, then the amount will help the interest rate now amounts will be higher because the principal amount has been increased. So not this distinction that the interest rate will be the same, but only the amount is that will vary. With the simple interest, you just get the interest from the principal that you have deposited, while with the compound interest, it will take the interest plus the interest previous, and then they will calculate the interest to give you in that coming tenure. Thank you, fella, for listening, and I'm glad that you have learned some few things from this video. So until next time, my name is Rita JL, and please don't forget to tell a friend, to tell a friend, to tell a friend to get logged with the Rita Series. Until next time, bye bye.